I'm going to be showing you a strategy which I've been trading, which has been getting really good results, and I wanted to share it with you. So it's a reversal trading strategy, which also incorporates some elements of SMC and also incorporates a few elements of the momentum trading, which I have been using previously, but ultimately it's on small time frames, and I've been trading it on the indices, so on the FTSE 100, or the UK 100, on the US 30, and on the NASDAQ. So it works really, really well on those markets. I don't know how it works on Forex yet, but I'm looking forward to testing it out. If you're excited to learn the strategy, then make sure you hit the thumbs up button now. It's good for the YouTube algorithm. It means I can carry on creating this free content for you, and it'll help reach more people. So the reason why I came up with this strategy, or I started to develop it, was because one of the traders who I coach was having difficulty with reversal trading, in that he really liked doing reversal trading on smaller time frames and he wanted to carry on doing that, but he was having difficulty with the precise moment to enter, because sometimes he would get a really nice entry and then other times he'd end up getting caught in this kind of weak point, you know, when the market's reversing and it doesn't reverse straight away. Kind of like down here, I'm just going to show you here. Do you see where it takes a little bit of time sometimes for the market to actually change direction. And if you end up getting caught in this volatile points, then you can often end up losing a lot of money, because each candle is often bigger than your maximum stop loss. You can end up just losing lots of money and getting stopped out left, right, and center the minute you enter into the trade. So timing is really important with reversal trades, especially when you're doing them on the short time frames. If you enter too quickly, you'll end up taking too many losses, just getting stopped out. If you enter too late, you'll end up missing a lot of the big moves. The first part of this strategy is that you want to identify when a trend is coming towards the end, and we are going to be looking on the small time frame. So I like to use the 1 minute on this one. So usually when a trend comes towards the end, the first sign of that is actually a really big pullback. Now, in this case, this isn't actually a textbook example, but I think that sometimes it's more beneficial if I show you an example that isn't textbook, rather than showing you a perfect example where everything goes exactly right. And then when odd little things come up in your trading, you won't know how to deal with them. So this is actually a very messy example, but I think that that works better in some ways to help you to understand it on a messy example rather than a perfect example. But in a trend, say we're going from a downtrend to an uptrend, and you're trying to get this move on the way up, ultimately you're looking for that downtrend to start coming towards the end. And the first sign is often a big pullback, a very, very big pullback. Now, actually, we got it right up here on the open, on the London Open. There was actually a really big pullback straight away. So this actually usually happens towards the end, but because it was the open, we'll let it off. But this, again, it happened again there. So it was quite a messy downtrend when these big pullbacks were happening all the way down. That's actually not normal. Can you see on this uptrend here, this is a little bit more smoother than it is on the way down. This is the sort of big pullback that you're looking for, this sort of thing here, when it's a bit more dramatic. So that's the first sign. We'll look at this one here, because I guess in a weird way, this works, although you'd be forgiven for thinking that this was the start of a new trend. So you're looking for that first sign that the trend that you're in is coming towards the end. Now, because reversals take so much energy almost to change direction, they don't happen straight away. So the last thing you want to do is to enter into a reversal trade on the first sign that the market might be changing direction. It's the first sign that you want to start paying attention and perhaps exiting or planning to exit the trade that you're already in, if you're in a trade in the opposite direction. But you want to then wait, and I call it the pit. It's like the pit that gets formed when you are going from one direction to the other. So it works nicely on from a downtrend to an uptrend, because you get this kind of pit forming here. And obviously it doesn't usually work out the first sign, although we have this really nasty example here with this very extreme pullback here, which I've decided just to use, even though this isn't normal. I've decided to keep it in rather than looking for a textbook example. So yeah, you would be forgiven for entering in here and just taking a small trade and then re-entering again down here. But you get this pit that forms as the market starts to reverse. So in this point, you're actually waiting. And there is a lot of waiting in trading well, because you really do want to get that precise entry. So when the pit forms, we're on the 1 minute chart. The next thing I want to do is I'm going to open up in TradingView so that there's 2 screens. And then on the second screen, I'm actually going to put it on a different time frame. So I'm going to go to the 5 minute time frame, and I'm going to go to Heikin Ashi. So one of the screens that I'm looking at is on normal candlesticks, and it's on the 1 minute. And the second one is on the 5 minute, and it has Heikin Ashi. So for those of you who aren't familiar with Heikin Ashi, this is one of my favorite tools to use to gauge momentum. It's particularly useful when you are looking for reversals, because it can help to distinguish between a pullback and a reversal. So the way that I use it is, if you break down the candlesticks into 3 main candle types, there's bullish momentum candles, there are bearish momentum candles, and there are indecision candles. Bullish momentum candles are green. They have a flat base and they've got wick at the top. So these candles here are all bullish momentum. And obviously you'd expect to see bullish momentum candles in an uptrend. And then bearish momentum candles have a flat top. They're red and they've got wick at the base. And again, you would expect to see them in a downtrend. And indecision candles can be either color. They've got wick at the top and at the base, and they signal either a bit of indecision, a pullback, or the start of a reversal. The first rule is to never make a decision on an indecision candle, because at the point of indecision, there's no way of knowing if it's just a pullback or if it is an actual genuine reversal. So it's just the first sign you want to be paying attention when you see an indecision candle. In this strategy, we're going to be looking for 2 confirmations. So when we see the pit forming, rather than to enter straight away, what we want to do is we want to see 2 things happening, and they can happen in either order, but we enter on the second one. And so what this does is it prevents us from entering into a reversal too quickly. And it means that we are actually waiting for momentum to change direction, as well as for certain levels to get broken. So the first thing that we're looking for on the 1 minute time frame on the normal candlesticks is for the highest point of the pit to get broken with a long bodied candle. And the second thing is on the 5 minute time frame on Heikin Ashi, we're looking for momentum to actually have changed direction to the other side. So sometimes one will happen before the other, and it will change from trade to trade. So you're entering on the second one. So in this instance, I think that momentum changed direction first, and then we got the break of the highest point. So we're going to look at this messy example first, because actually in reality, you would have been forgiven for taking a trade here. And that's fine, because not all trades pan out, because the market does weird things like this all the time. And it's fine to have a go and just to manage your risk appropriately, get out and try again. So actually you probably would have entered here. On this one, you can see that the momentum changed here at 8:55. And the highest point of the pit got broken here. I'm just going to draw on a little line so you can see what I'm talking about. So can you see how this was the highest point and it got broken here? So that was at 8:51. So this happened first at 8:51, and then we had to wait for the 5 minute candle here to close before we would enter. And so that would be around here. Unfortunately, this one didn't pan out. On the UK 100, my maximum stop loss is 5 pips. So that's all the risk that you'd be taking on this trade. On the US 30, it'll be 20, and on NASDAQ, it'll be 10. But on this one, it would be maximum would be 5 pips. So this one wouldn't have worked out. If you'd have moved your stop loss to entry, then you would have just broken even, or you would have taken a 5 pip loss. Then we have a second go down here. And you can see that I'm just going to mark it up. That becomes the highest point. Arguably, it's that point, but to be fair, there you go. They both are the same. So that's the highest point of the pip. It gets broken here at 9:40 and actually at 9:35. So this one actually would have been around the same time because that was the first time that momentum changed to the upside. And that would have been your exact precision of entry. So I'm just going to draw that on for you so you can see where you would have gone in there. So you would have gone in there, you would have taken a 5 pip. You have to do it as 500 there. So that would have been your risk that you'd have been taken. And this would have been the trade that you were in. And I'm just going to drag that up there. Now, getting out of this trade, what you want to do to get out of this trade is you're not going to set a set take profit. You're actually going to wait until the market does the thing that would have got you into a trade in the opposite direction. So let me explain. So remember I said that you get a really steep pullback is often the first sign that you're coming towards the end of a trend. But that's not the time to exit because often the highest point still gets broken. So what I mean by that is this is a really steep pullback that we get here. So this is the first steep pullback. If you exit at this point, obviously, that would have obviously got you a lot less than if you'd managed to hold it all the way up here. Can you see that was about 17 pips down there? And up here, it's more like 23. So what you want to do is you actually want to wait for the steep pullback to happen, but set your take profit somewhere, usually just a couple points below where the previous high was, because it does often get taken out in, I don't know, it doesn't, the word pit doesn't work the same when it's at the top. We call it the mountain or something. But at the top of the hill or whatever, that highest point does often get taken out. So in order to, there you go, it gets taken out here. So in order to get the most points out of this trade or the most profits out of this trade, you actually want to wait or set your take profit a little bit around this area, a little bit further down is the safest way to do it, but it does often take it out. And that is the best way to maximize your profit. So it feels really uncomfortable when you feel the market starting to go against you and you have to hold it and wait and hope that it does actually come back. But it's very rare for a market to do a very sharp reversal. It takes so much energy for something. Even in real life, it takes a lot of energy for a vehicle to change direction and get momentum in the opposite direction. And in trading, it takes a lot of energy for the financial markets to just change direction as well. So there is usually this period where it messes around for a little bit. So to get the most points, you actually want to do the really uncomfortable thing and hold through this and wait for it to come back up. So this one actually wasn't the best trade in the world because it was only 23 pips, which I would usually want more out of the UK 100. But we're also at a bit of a strange point on the day chart where it is being a little bit indecisive. This one got a risk to reward ratio of 1 to 4.67. So let's say 4.5. So it was a fair risk to reward ratio. And you can often get a couple of these in the London session and a couple in the New York session. So it depends what session you're trading. But I hope you found this video helpful and let me know how you get on with this strategy. And if you try it on any other markets, on any of the Forex markets, then I'm really interested to hear how you get on.